Congratulations. If you're listening to my voice right now and you're still holding your physical silver through the most coordinated, calculated, and transparent paper manipulation event of the year, you have just passed the final test. You have proven that you understand the difference between mechanical selling and fundamental weakness. You have demonstrated that you can distinguish between temporary noise and permanent signal. Ladies and gentlemen, Asian guy here from Drucker Investors, the mainstream financial media, the brokerage firms, the bearish analysts, they are all screaming the same message right now. They are telling you that silver is crashing. They are showing you charts with red candles. They are publishing articles with headlines like "Silver tumbles 5% and an index rebalancing triggers sell-off." They want you to believe that the rally is over, that the fundamentals have changed, that you should cut your losses and move on. But here is what they are not telling you. Here is the smoking gun that proves this entire narrative is a manufactured hoax designed to shake out weak hands before the next leg higher. The selling you are seeing right now, the $6 billion of futures contracts being dumped on the COMEX between January 8th and January 14th, is not driven by fear. It is not driven by deteriorating fundamentals. It is not driven by institutions losing faith in silver. It is driven by a mechanical rebalancing of the Bloomberg Commodity Index and the S&P Goldman Sachs Commodity Index. It is forced selling by passive tracking funds that have no choice but to liquidate positions. Because silver performed too well last year, let that sink in. They are selling because silver went up too much. They're not selling because silver is weak. They're selling because silver is strong. And the brokers, the very people who are supposed to work for you, are using this known, scheduled, published event to push you into short positions so they can profit from your panic. I know what some of you are thinking. I can already see the comments forming. Asian guy, silver dropped from $84 to $74 in 3 days. That is a 12% crash. How is that bullish? How is that a hoax? To those people, I say this, you are confusing price action with causation. You are watching the screen instead of reading the data. Let me walk you through exactly what is happening right now, who is selling, why they are selling, and why this selling pressure will evaporate by January 15th. On January 3rd, 2026, multiple financial institutions including Scotiabank, Citigroup, and JP Morgan published research notes detailing the flows associated with the annual commodity index rebalancing. These notes were not secret, they were not leaked. They were published openly for institutional clients. Scotiabank estimated that approximately $7.1 billion worth of silver futures would be sold during the rebalancing window. Citigroup estimated $6.8 billion. JP Morgan estimated $3.8 billion in silver and $4.7 billion in gold. The exact numbers vary depending on the methodology, but the conclusion is the same. Billions of dollars of silver are being mechanically sold over a 5-day period starting January 8th. This is not a surprise. This is not a black swan event. This is a scheduled, predictable annual occurrence that happens every single January. The Bloomberg Commodity Index rebalances every year to maintain target weights for each commodity. Silver's weight in the index is capped at 4%. But because silver rallied 145% in 2025, its actual weight in the index exceeded 9% by the end of the year. The index rules require that excess weight to be sold. So the passive tracking funds, the ETFs, and institutional investors who mirror the BCOM are forced to sell silver futures regardless of what they think about the fundamentals. They have no discretion. They have no opinion. They are robots executing a predefined algorithm. Sell the winners, buy the losers, return to target weights. And the brokers know this. The brokerage firms that sell retail traders access to silver futures know exactly when this rebalancing is happening, how much is being sold, and how it will impact the price. So what do? They send out research notes recommending that clients short silver. They publish articles warning of a dramatic repricing lower. They raise margin requirements to make it more expensive to hold long positions. They are engineering a panic to create liquidity for their own book. They are front-running the rebalance by convincing you to sell so they can cover their own shorts at better prices. Let me show you the smoking gun evidence that proves this is a coordinated manipulation. First, the timing. The selling pressure started on January 7th, 1 day before the official rebalancing window. Silver dropped 5% on January 7th. Gold dropped 1%. Why did silver drop harder than gold? Because silver has lower liquidity and because brokers were pushing shorts harder in silver than in gold. The bearish research notes from institutions like TD Securities specifically targeted silver. They warned that 13% of total open interest in COMEX silver would be sold. 13%. That is a massive number, and it is designed to scare you. But here's what they did not mention. 13% of open interest is only 13% if nobody is buying. If physical buyers step in, if industrial users take delivery, if sovereign wealth funds absorb the selling, then that 13% gets soaked up without moving the price. And that is exactly what's happening. We are receiving reports from dealers in Asia that physical demand during this dip has been ferocious. The Shanghai Gold Exchange Premium, which measures the difference between the price in China and the price in New York, widened to $14 per ounce on January 8th. $14. That is a 19% premium over the COMEX price. That tells you that while paper sellers in New York are dumping futures, physical buyers in Shanghai are paying whatever it takes to get the metal. The bifurcation is complete. The paper market and the physical market are no longer connected. The COMEX price is a fiction. The Shanghai price is reality. Second, the margin hikes. On January 6th, just 2 days before the rebalancing window, the CME Group raised margin requirements for silver futures. They raised the initial margin from approximately $22,000 per contract to $25,000 per contract. That is a 14% increase. Why would the exchange raise margins right before a known selling event? If they were worried about volatility, they would have raised margins in December when silver was hitting all-time highs. But they did not. They waited until January 6th. They waited until the rebalancing was about to begin. This was not a risk management decision. This was a strategic decision to force retail traders to liquidate long positions before the institutional selling started. Think about the mechanics. If you are a retail trader holding 5 silver contracts with maximum leverage, you have $110,000 in your account. The contracts are worth $375,000 at $75 per ounce. Your leverage is roughly 3 to 1. When the CME raises margins by $3,000 per contract, you suddenly need an additional $15,000 to keep your position open. If you do not have that cash sitting idle, you are forced to sell. You become part of the selling cascade. And who buys from you? The market makers, the same institutions that lobbied for the margin hike. They pick up your contracts at $74, hold them through the rebalancing, and sell them back to the index funds at $78 a week later. It is legalized front running, and it happens every single year. Third, the media narrative. Go look at the headlines from January 7th and 8th. Bloomberg published an article titled, "Silver Tumbles 5% Amid Profit Booking," and scheduled reshuffling of commodity index funds. StockTwits ran a story titled, "Silver Falls Ahead of Index Fund Rebalancing." Yahoo Finance covered it with, "Silver and Platinum Plunge to Extend Big Spike in Volatility." Notice the language. Tumbles, plunge, volatility. They are framing this as chaos, as a breakdown, as a reason to panic. But buried in those same articles, usually in the 7th or 8th paragraph where most readers never get to, they admit the truth. This is scheduled. This is technical. This is not driven by fundamentals. Scotiabank, in their research note breaking down the rebalancing flows, explicitly stated that they recommend buying silver on any weakness caused by these flows. Read that again. The bank that published the estimate of $7.1 billion in selling is telling their clients to buy the dip. Why? Because they know this selling is temporary. They know that by January 15th, the rebalancing will be over, the pressure will dissipate, and the price will snap back. But the retail investor, who only reads headlines, who only watches CNBC, who only follows the 5-second sound bites, that investor hears silver crashing and hits the sell button. That is the hoax. The hoax is not that the rebalancing is happening. The rebalancing is real. The hoax is the implication that the rebalancing changes the fundamental case for silver. It does not. Industrial demand is still growing. Solar panel installations are still accelerating. Battery production is still ramping. Defense spending is still rising. Central banks are still diversifying out of dollars. China is still hoarding metal behind their export ban. None of that changed because a passive index fund had to sell some paper contracts. Let me explain the mechanics of how the rebalancing actually works, because if you do not understand this, you will misinterpret the price action. The Bloomberg Commodity Index holds futures contracts in 25 different commodities. Each commodity has a target weight. Those weights are calculated based on production levels and liquidity. Silver's target weight for 2026 is 3.98%. On December 31st, 2025, after a year in which silver rallied 145%, silver's actual weight in the index had grown to over 9%. The index rules state that no single commodity can exceed its target weight by more than a certain threshold. When that threshold is breached, the index must rebalance. The rebalancing happens during a 5-day window starting on the 8th business day of January. This year, that window is January 8th through January 14th. During this window, the passive funds that track the BCOM execute to sell orders for silver futures, and buy orders for the underweight commodities. The orders are not placed all at once. They are phased in gradually, typically 20% of the total flow each day. So if the total selling is $7 billion, roughly $1.4 billion is sold each day. The orders are typically executed at the market close or using volume-weighted average price algorithms to minimize market impact. But here's the key. These orders are price insensitive. The funds do not care if silver is at 75 or 70 or 65. They have to sell the target amount regardless of price. This is why the selling can feel relentless. It is not driven by fear. It is driven by obligation. Now, who is on the other side of these trades? Who is buying the $7 billion of silver that the index funds are dumping? Three groups. First, the market makers. The big banks and trading firms that facilitate the transactions. They buy from the index funds and then immediately hedge by selling in the physical market or by selling to other clients. They do not take directional risk. They make money on the spread. Second, the contrarian speculators. The hedge funds and commodity trading advisors who know that rebalancing creates predictable dislocations. They buy the dip because they know the selling will stop on January 15th and the price will recover. Third, and most importantly, the physical buyers. The industrial users, the sovereign wealth funds, the Asian retail investors who are converting paper weakness into physical strength. And this third group is the reason why the price has not collapsed further. Silver dropped from 84 to 74, a 12% decline despite $7 billion of selling. Why did it only drop 12%? Because the physical buyers absorb the majority of the flow. If there were no physical demand, if the only participants were paper traders, the price would have dropped 30 or 40%. The fact that it dropped 12% tells you that for every seller, there's a buyer willing to take the other side. And those buyers are not flipping the metal back onto the market. They are taking delivery, they are moving it to vaults, they are removing it from the available supply. This is why the registered inventory on the COMEX continues to bleed even during the rebalancing. The metal is leaving the system. Let me address the trap that the brokers are setting for retail traders because this is where most people are going to lose money. The brokers are pushing two narratives right now. Narrative 1, silver is crashing. You should sell before it gets worse. Narrative 2, silver is going to drop further during the rebalancing. You should short it and profit from the decline. Both narratives are designed to transfer wealth from you to them. If you sell your physical silver because you think the rally is over, you are locking in a loss and giving up your position right before the next leg higher. If you short silver futures because you think the rebalancing will push it lower, you are betting against industrial demand, sovereign buying, and the physical shortage. You are playing the paper game, and the paper game is rigged. The brokers want you to short because they know the rebalancing ends on January 14th. They know that by January 15th, the selling pressure will be gone and the price will stabilize. If you short at 74 and the price bounces back to 80 by January 20th, you're going to cover at a loss. And who profits? The broker who sold you the contract and the market maker who bought it from you. Do not fall for it. The correct play during a known, temporary, mechanical selling event is to do nothing if you own physical, or to buy more if you have cash. It is not to panic. It is not to trade. It is not to try to time the exact bottom. Because by the time you realize the bottom is in, the price will already be back at 80 and you will have missed the opportunity. Here is the battle plan for the next 10 days. First, ignore the price on your screen. If you own physical silver, the number on your computer is irrelevant. Your ounce is still an ounce. The value has not changed. Only the paper reference price has changed. And that paper reference price is being manipulated by index flows that have nothing to do with the real world. Second, watch the Shanghai premium. If the premium widens beyond $15, it confirms that the physical market is completely decoupled from the paper market. It means that while COMEX sellers are pushing the price down, Shanghai buyers are bidding it up. The arbitrage gap will eventually force convergence. And convergence means the COMEX price rises to meet the Shanghai price, not the other way around. Third, watch the registered inventory. If inventory continues to drop during the rebalancing, it proves that physical demand is overwhelming the paper selling. It proves that the metal is leaving the vaults faster than the index funds can dump contracts. Fourth, watch the open interest. If open interest declines sharply during the rebalancing, it means shorts are covering and longs are liquidating. That is bullish. It means the weak hands are out and the strong hands are accumulating. Fifth, do not set stop losses. If you have a stop loss order sitting below $70, remove it. The brokers can see those orders. They will wick the price down just far enough to trigger your stop and then rally it back up. It is a classic stop hunt. Do not give them the satisfaction. Here is what the skeptics are going to say. They are going to say, Asian guy, you are always bullish. You never admit when silver is weak. You are a permabull who ignores bad news. To those skeptics, I say this, I am not ignoring the selling. I am explaining the selling. There's a difference between being bullish and being informed. The selling is real. $7 billion of futures contracts are being liquidated. But the reason for the selling is mechanical, not fundamental. And mechanical selling creates opportunities, not disasters. If you sold your gold in 2008 because Lehman Brothers collapsed and the price dropped from 1,000 to 700, you locked in a 30% loss. If you held through the panic and bought more at 700, you made 10 times your money over the next 3 years. The principle is the same here. The rebalancing is temporary. The deficit is permanent. The index funds will finish selling by January 14th. But the solar panel factories will keep demanding silver. The battery plants will keep demanding silver. The defense contractors will keep demanding silver. And the supply will not increase because the mines are already producing at capacity. When temporary selling meets permanent demand, the price does not stay down. It snaps back. And the people who bought the dip will be rewarded. The people who panic sold will be left behind. Let me zoom out and explain why this rebalancing hoax is actually proof that we are in the final phase of the silver bull market. The fact that brokers are this desperate to create selling pressure, the fact that they are using a scheduled rebalancing event as an excuse to push bearish narratives, the fact that they are raising margins and publishing scary research notes tells you that they are terrified. They are terrified because the physical shortage is real. They are terrified because the delivery demands are accelerating. They are terrified because the vault inventories are declining. If silver was genuinely weak, if the fundamentals were deteriorating, if demand was collapsing, the brokers would not need to manufacture a crisis. The price would fall on its own. But it is not falling on its own. It is only falling because $7 billion of forced, mechanical, price-insensitive selling is hitting the market over 5 days. And even with that selling, the price is only down 12%. That is not weakness. That is resilience. That is proof that the physical buyers are real, that the demand is real, and that the narrative of a meltdown is fake. The meltdown hoax is exposed by the fact that it requires artificial intervention to create. A real meltdown does not need margin hikes. A real meltdown does not need bearish research notes. A real meltdown does not need brokers pushing shorts. A real meltdown happens organically when fundamentals break. But the fundamentals of silver have not broken. They have strengthened. The deficit is widening. The industrial demand is accelerating. The monetary demand is growing. And the supply is constrained. That is not a meltdown. That is a setup for an explosion. The end game is approaching faster than most people realize. We are not just in a silver bull market. We are in the final innings of a 50-year monetary experiment that is failing in real time. The dollar-based fiat system is breaking. The confidence in paper assets is eroding. The flight to hard assets is accelerating. And silver, because it is both a monetary metal and an industrial commodity, is the perfect vehicle for this transition. The people who understand this are loading up during this manufactured dip. The people who do not understand this are selling into the panic. And 6 months from now, when silver is at 150 or 200, the sellers are going to look back at this moment and realize they made the biggest mistake of their investing lives. They sold the dip right before the breakout. They believed the hoax. They trusted the brokers who were lying to them. This is not financial advice. I am not telling you to buy or sell anything, but I am telling you to think critically. I am telling you to read beyond the headlines. I am telling you to understand the difference between mechanical selling and fundamental weakness. The rebalancing ends on January 14th. The physical shortage does not end. The industrial demand does not end. The monetary crisis does not end. And when the temporary selling pressure lifts, the price is going to reflect the reality that the brokers are trying to hide. Silver is not in a meltdown. Silver is in a squeeze. And the brokers pushing shorts are going to be the ones who melt down when the squeeze accelerates. This is Asian Guy from Drucker Investors. The hoax has been exposed. The trap has been identified. And if you are still holding, you are on the right side of history. Do not let them shake you out now. Like, subscribe, and share this message with everyone who needs to hear the truth. The rebalancing ends in 6 days. The bull market is just beginning.